Veteran market bull Ed Yardeni is broadening his view on the market heading into 2026. After years of backing big tech, Yardeni is reshuffling the deck. As AI spending and valuations collide, he explains why he's pivoting away from the Magnificent Seven and the companies building AI to focus on the industries using it to win. You've long touted the 2020s as the new roaring 20s for economic and productivity growth. Is that still your perspective right now?
Even more so, because if the real winners of AI are the users of AI, the users are you that are getting productivity by using these technologies, and because of competition, they don't have to pay that much for the hardware and the software. Then that would boost productivity, and that would boost real GDP, keep inflation down, and continue to fuel the roaring 2020s. What I don't want to see happen is I don't want to see the kind of speculative excesses of the 1920s that led to the crash. And so I am actually encouraged by the fact that there's so much nervousness about a bubble, because that reduces the likelihood of it. And as I said, it kind of takes some air out of it. I think it'll be good for the economy and good for the market.
Where do you see the S&P 500 landing by the end of 2026, and what's the biggest swing factor behind that?
I mean, I know valuation levels are high, but they've been high for a while. I think to a large extent, this has in fact been an earnings-led market, and I think it continues to be an earnings-led market. And I think earnings at the current valuation levels of about 20 to 22, I think earnings could get the S&P 500 up to 7,700 by the end of 2026. We're around 7,000 now, so that would give us a 10% increase in the S&P 500. By the end of the decade, by the end of what I think will turn out to be the roaring 2020s, I could see the S&P 500 at 10,000, and that would be at the end of 2029. And productivity would be a big part of that story.
And how much real productivity does the market need to see in 2026 to justify current AI-driven valuations?
That's a good question. There's no science about it, but I would say that the average growth rate of productivity since the data was collected in the late 1940s is 2% per year. I think that if we can get just 3% per year, that would be a big deal, because productivity plus the growth rate in the labor force is what gives us the growth rate of the economy.
And you've said that there's no way these companies can really know if their AI spending will pay off. How much uncertainty can the market really absorb before it starts behaving like a bubble?
Well, that's why just last week I said it's time to underweight the Magnificent Seven, because until now there was almost no uncertainty about how magnificent these companies were. Now there's nothing but uncertainty, and particularly in terms of if they continue to commit this kind of capital spending, who knows what kind of return they're going to get on it. They may not get much of any return. At any rate, it certainly looks like the growth rate of their earnings is going to slow, because they are spending a lot more on capital. They used to be companies that didn't have to spend much on capital and didn't have to spend much on labor. They were very light in resources and really great in generating earnings. Now, not only are they spending a lot of money on expanding their data centers, but they're paying a fortune to get talent, and that's going to all squeeze their profitability.
And to wrap things up here, what parts of the market do you expect to outperform in 2026 as AI adoption spreads beyond big tech?
I would say AI hyperscalers, the Magnificent Seven, have had a great run here. They tended to be fairly closely correlated. Now we're seeing some dispersion, where some stocks, yes, a few of the seven are doing well, a few aren't doing well, and that could continue to be a dance that continues with the Magnificent Seven. I think it's the users of their services that in AI and other areas that will increase their productivity. So I would see the market broadening to the S&P 493. And altogether, I would continue to overweight. Well, like I recommend now, in terms of information technology and communication services, I've lowered my recommendations from overweight to market weight. I'm not underweighting the way I am Magnificent Seven, because there's plenty of semiconductor companies that are still going to do very well, for example. But I do think that financials, industrials, and now healthcare, which I have been recommending overweighting financials, industrials. I'm just saying, whatever money you're taking out of information technology and communications, put some more in financials, put some more in industrials. And a sector that I haven't had much interest in, healthcare, is one that I would overweight, particularly in the biology area.
Yardeni still believes the 2020s can be a productivity boom, but says the next leg of the market looks broader and more earnings driven. His message for 2026 is simple: less concentration, more discipline, and a market that rewards who actually puts AI to work. For Investors Business Daily, I'm Clara O'Connor.